Good morning, everyone. I'm here with Bob Hagenow. My name is Mike McDonald. We'll be going over some business year-end tax planning. So we're going to start with an update to the CARES Act and the Tax Care and Jobs Act related to net operating losses and business interest expense and some payroll tax credits. So with net operating losses under the old TCJA Act, it removed the ability for taxpayers to carry back a net operating loss to the prior 2 years. The CARES Act that came out in March of 2020 provided for a 5-year carryback. This is for any NOLs generated in tax years 2018, 2019, and 2020. So taxpayers now have the ability to do a 5-year carryback or carry it forward indefinitely. The 5-year carryback, one thing to be aware of is that you have to carry it back to the 5th preceding year first. So there is a good opportunity for a corporation where the corporate tax rates were graduated rates, with the highest rate being 35%. For tax years pre-2018. The current corporate tax rate is 21%. So you do have a good opportunity if you generated an NOL in 2020 to carry that back. You would first look at your 2015 tax year, carry back the loss to that year first. And then you would move forward to 2016, 17, 18, and then 19. Any losses being carried forward after 2020, they will be subject to the 80% of taxable income limitation. So meaning if you generate a 2020 loss and you choose not to carry it back, when you carry it forward to 2021, you will be limited to no more than 80% of your 2021 taxable income. So if you have a $1 million NOL generated in 2020 and $1 million of income in 2021, you'll be limited to $800,000 NOL deduction and would be left with $200,000 of income for 2021. Another item that impacts pass-through businesses, so partnerships and S corporations, is the excess loss limitation. The excess loss limitation was a limitation that was put in place by the TCJA at the end of 2017, where it limited your ability to deduct for married filing joint more than $500,000 of a loss generated by a pass-through business. In 2018, 19, and 2020, that $500,000 loss limitation was applied after factoring in any W-2 wages for an S corporation. So let's say you had W-2 wages as a shareholder of $250,000 and you generated a business loss from the S corp of $600,000. You would have an overall loss of $350,000 and you would get a full $350,000 deduction. In 2021, if you have those same numbers of $250,000 of wages, $600,000 loss from the S corp, you're going to be limited to only deducting $500,000 of that $600,000 loss. So something to keep in mind when looking at 2021. You might want to, when looking at 2020, maybe keep in mind 2021, what are you forecasting for 2021? And if there's any maybe deductions you can accelerate into 2020 or vice versa. Another item is the business interest expense limitation. So this was, again, put in place with the TCJA, where if you had average annual gross receipts in excess of $26 million over the 3 preceding years, your business interest expense was potentially limited to 30% of your adjusted taxable income, which was your taxable income, adding back interest expense, depreciation, and amortization. For tax year 2020, under the CARES Act, the limitation is now 50% of your adjusted taxable income, or 30% if you elect to do the 30%. The other advantage that is there with the CARES Act is you can opt to use 2019's adjusted taxable income when calculating the limitation. So if you expect your 2020 adjusted taxable income is going to be significantly lower than 2019, and you're concerned with an interest expense limitation, you would be able to elect to use 50% of your 2019 adjusted taxable income to come up with that interest expense limitation. Another item that came out with the CARES Act was the paid sick leave or child leave credit. This allowed for a credit against payroll taxes for employers who paid an employee while they were required to take a COVID-related leave. This came as part of the Families First Coronavirus Response Act. So this is a payroll tax credit, not an income tax credit, but this credit is available through the end of 2020. So it's something else when doing your year-end planning. Make sure if you had any employees who took an eligible leave because of COVID, that you are getting that credit on your payroll taxes. So with the net operating losses, it is the 5-year carryback is very beneficial, considering the fact that the corporate tax rates were much higher pre-2018. So this is a good opportunity to see if you can accelerate any losses into 2020 and then be able to carry those back. You do have to keep in mind other limitations that existed in those earlier years, such as the alternative minimum tax. So the carryback of that loss for AMT purposes will be subject to the 90% of pre-NOL AMT income. So it's definitely a good opportunity, but planning would be required by year-end to see, are you better off carrying it back or carrying it forward? With that, I'm going to turn it over to Bob Hagenow, and he'll go into more in-depth on some other year-end tax planning opportunities. Bob?
Thanks, Mike. Hello, everyone. I'm going to go through some things that we can consider now that we're approaching year-end. In a perfect world, we know where we stand going into next year and be able to, decide which is the best techniques we can use to change our tax situation as we're coming with our year-end planning. Unfortunately, as everyone knows, we're sitting here in December and we don't really know what the makeup of Washington's going to be like, and therefore we don't know, who's going to be driving the policy for taxes. So potentially, things could change a lot. Right now we're sitting here. Some of us think that there's a possibility for certain tax rates to go up, and some people feel like, possibly things are going to stay about the same. So with that in mind, let's go through a couple techniques and areas of interest. One would be looking at the method of accounting. Your method of accounting dictates when income and expenses would be recognized. Under the accrual method, that method, you really are matching your items of income and items of expenses into the period in which they relate. Under the cash method, it's simply you're recognizing income when you receive the cash, and you're picking up expenses when you're paying out the money for those expenses. So if we look at it, for small businesses, there's some opportunity there, because the IRS and Congress have identified small businesses as being those businesses with 3-year average gross receipts not exceeding $26 million. So that's a pretty big number, and applies to a number of taxpayers and businesses. And what the cash method allows you to do, it gives you flexibility to shift income and expenses, and you can shift income by deferring billing at the end of the year, or paying expenses early. It's a valuable tool when we're sitting in times like these, where tax policy and rate changes are anticipated between years. And certainly I think that there will be some changes. We just don't really know where they are. So it's something to consider as you're going through year end, is what accounting method do you have? Is it the right accounting method for you? And should you consider changing your accounting method and potentially use the cash method, which would give you some flexibility. Then we look at, what can we do with, certainly if we're buying assets and property at the end of the year, what can we do with those to possibly accelerate some of our deductions? And that's really important if we feel the tax rates are, we want to take advantage of more deductions now because of the tax rate that we're in, or, potential changes that might be coming up in the future. Maybe these opportunities won't be available going forward. But if you look at Section 179, it allows taxpayers to make an election to deduct the expenses they incur for certain property. It's available to most property except buildings. It's for business use vehicles, and on these vehicles there's some additional limitations that apply. So if you have those, we can certainly walk through the limitations with you. It applies to off-the-shelf software. It applies to qualified improvement property, which would be interior parts of the building. It does not include elevators. It does not include escalators. And like we said before, it doesn't include real property or the buildings themselves. The limits on expensing under 179 is $1,040,000 for Section 179 property placed in service. There's a dollar for dollar phase out, and the range for the phase out is, dollar for dollar starting at $2,590,000 through $3,630,000, and after that, it would be totally phased out. The one nice thing with Section 179, and we'll see for the current bonus depreciation, it's not prorated based on when the expense is incurred. So if I put something in service in December, I'm not just getting 1/12 of it. Under Section 179, I'm able to deduct the entire amount, which is a pretty nice incentive. Bonus depreciation may be available after we reach these Section 179 limits. Now, what I will say is Section 179 and bonus depreciation are two different types of opportunities for us to depreciate and take expenditures. However, they're not the same thing. So you can decide to not elect to take Section 179 and go ahead and take bonus depreciation. And bonus depreciation, you actually have to elect out of bonus depreciation if you do not want to take that, which we'll cover on the next slide. And also, one thing that's important with Section 179 is that there's a lot of variety in how states treat Section 179. So you're going to want to make sure to take that into consideration in any of your planning, not only the federal tax rules, but also the state tax rules. Okay, on bonus depreciation, that's a depreciation that's really a special depreciation setup in the tax law that allows you to accelerate depreciation, and currently for 2020, businesses are permitted to take 100% deduction for new or used property with a class life of 15 years or less. So there's some, great opportunities if you're so inclined to be adding property to your businesses. And it's not your building property, but it could be your building improvements, it could be equipment, it could be machinery, it could be your land improvements. Those kind of things, you have an ability to deduct those costs. And again, with this, as I mentioned before, there is no prorating based on when you do it. So it's something that you can still accomplish in 2020 if you do it in December. And with bonus depreciation, there's all kinds of different state tax treatments. So make sure you keep that in mind as well. The de minimis safe harbor election, what that does is, sometimes when you add property or you make acquisitions of property, for tax purposes, you might have to capitalize that. But for book purposes, you might have taken a position that, hey, it's under a certain dollar amount, I'm just going to expense it. Well, that's under your book capitalization policy. You've decided what you're going to do for book purposes. Under this safe harbor election, it's also known as the book tax conformity election, which basically, so for book purposes, let's say you have a policy where you're going to deduct $5,000. If you have an invoice for $5,000 of property, you're going to take the position, I'm just going to expense that because it's not worth setting it up for depreciation. Well, this gives you the ability to do that. However, you should look, and we encourage that this is a great time for taxpayers to step back and look at your book capitalization policies and see what it says. Because one thing under this election, it allows the deduction of small dollar property acquisitions, and those small dollar amounts are defined as $5,000 per invoice for those taxpayers with applicable financial statements, generally an audit. And if you don't have the applicable financial statement, it might be $2,500 per invoice. You just want to make sure you match up your book capitalization policies to line up with this. So in order for us to take full advantage of depreciation that might be available to us, we might want to look at something that's called cost segregation. And that's simply, and you can identify this opportunity by looking at your depreciation schedules. If you see one asset on the books and it says building, and it's $1 million, and you have nothing else, well, if you walk around your building, you're going to notice that there's other things. First of all, you parked in a parking lot. There's lighting in the parking lot. There's certain equipment. You might have, other types of machinery inside the building. And those things, if you look at it and you would just buy those independently, you know that they would not be considered to be building. So what this study is, it's a study to allocate the business costs to tangible personal property with shorter depreciable lives. And it's something that could accelerate your depreciation expense, thereby reducing your taxable income. And it's something that you really should consider it. And the best times to consider it would be really, in a lot of cases, existing buildings. There's an opportunity to go in and study and do a engineering study within the building and find out what its components are and break out those parts that should have been separated, like the parking lot and all those things I mentioned. New construction is the best time to work with the builder, work with the engineers in breaking out those components. And whenever you acquire property, that should be revisited to find out how much is land, which would not be depreciable, versus how much is depreciable property. And then of the depreciable property, what would be in each of the class lives that you might have. Residential rental real estate, oftentimes we just see a settlement sheet and the settlement sheet says you're buying the residential rental building for X amount of dollars. Well, if you set up that as building, first of all, you didn't break out the part of land that shouldn't be depreciated, and we didn't take an opportunity to break out those other components that could be depreciated over a shorter life. So that's this is one area. If you are involved in any of these types of things that we said we consider, is certainly let's talk them through and see if there's any ability to take additional depreciation and maybe accelerate some of your deductions. Now we could be sitting, we're sitting here in December, and we might have some real estate that we know we're going to have a sale on, or we have an opportunity to sell. Well, this under section 1031, this is what's the section that deals with like-kind exchanges. And this technique currently is only available to defer the recognition of gain on the sale of real property. A qualifying like-kind exchange requires a taxpayer to identify relinquished property and replacement property within a certain period of time. So if we're sitting here and we know we want to sell something, we might want to say, well, are we going to continue and reinvest in another property, and we're really not getting out of the business? And that's one thing I should point out, is this real property needs to be something that you're holding for either investment purposes or business purposes. So if I'm in the business of real estate and I have this real estate property, whether it's rental or not, and I want to defer the gain because I want that full dollar amount to reinvest in another property, then I certainly want to consider these like-kind exchanges so I can defer that recognition of gain as long as possible. And in so doing, in order for this like-kind exchange to work, you as a taxpayer or the business must never be in receipt of the funds from the sale, because if you receive the funds and they consider the sale to be complete, and therefore gain is triggered at that point. So there is a term that I just want people to be aware of. It's called the qualified intermediary, and that's a person, an entity that's set up to hold the property for you. And what they'll do is when you identify that you have a property to sell, that property is essentially parked with somebody else, and they accommodate the sale so that the gain is kind of deferred because it's being held at an intermediary level. And later on, when you get your replacement property, it's just like it's a wash between those two. And there's many steps involved in 1031 exchange. And again, we're just wanting you to be aware that there is an opportunity to defer gains, and the specific timing requirements when you do this is 45 days from the date of closing. You identify the new properties that you're looking to replace your old property with, and then you need to complete this exchange transaction within 180 days from the close of the purchase of the new property, to close on the purchase of the new property from the day that you close basically on the old property.
Yeah, and Bob, one thing I thought of too is for maybe a real estate professional, or someone that has maybe multiple rental real estates, and they've been actively managing it, and they say, you know what, it's time for me. I'm tired of managing this apartment complex, but so I want to sell this, but I'd like to stay in real estate. A Delaware statutory trust might be a good option for them, and that's where you could do a like-kind exchange and get into a DST investment. What the Delaware statutory trust does is it does invest in real estate, so it might be a hotel or some type of vacation resort, a multi-residential housing project, but you can take your money from the sale of your property and put it into here. And, it's like an investment where, you might get a 4 to 6% rate of return. There's specific criteria that a DST would have to meet based on IRS rules. But, it's something that's out there that could be an option for someone who, is looking to get out of having to do the day-to-day management, but would still like to stay in real estate.
Yeah, that's definitely a great consideration, because there is a point in everybody's life cycle where I think they don't mind still being involved in that type of business. They don't really need to take the cash out, but they certainly would like to get away from receiving those calls to deal with things that are going on at the apartment complex that they might have been managing for the last so many years. So thanks, Mike.
Yep.
Another thing is the qualified opportunity zones, and this is another mechanism where you can defer capital gains, and it's a situation where the taxpayers may invest some capital gains that they might have into a qualified opportunity fund, allowing capital gains to be deferred until 2026. So it has to stay in there relatively, not a tremendously long period of time, but you have to be committed that you're going to leave these gains in this qualified opportunity fund until 2026. The capital gains must be invested in the qualified opportunity fund within 180 days from the day you recognized the capital gain. So they have to be moved over to this fund within that 180-day window. And the qualified opportunity fund itself must invest 90% of its capital in a qualified opportunity zone property. And that's something you can look up, what are the qualified opportunity zones, and they are published. It's something that you can easily find, or, we can certainly talk to you about those. If the taxpayer, the benefit of this is if the taxpayer holds the qualified opportunity fund at least 5 years, they may exclude 10% of the original deferred gain. And if they go for another couple years, so they have it for 7 years, they can exclude an additional 5% of the original deferred gain.
All right, thanks, Bob. So I'm going to wrap up this section just touching on a couple of state tax updates for businesses to look out for. The one is the pass-through entity level tax for partnerships and S corporations. A couple years ago when the TCJ Act put a limitation on the amount of state and local income taxes a individual could deduct on their personal tax return, it was capped at $10,000. A lot of these states started to try and come up with workarounds to getting the deduction to their residents. There was a lot of things thrown around. The biggest one was basically taxing a partnership and an S corporation the same way you would tax a C corporation. When these first came out, we were unsure as to whether or not, would the IRS say, well, no, this is just a workaround. Those taxes are still going to be subject to the $10,000 cap. The IRS recently came out with guidance on the federal tax treatment and said, if the tax is paid by the partnership and the S corporation at the partnership or S corp level, it will be considered a ordinary business expense to the partnership and the S corp. So essentially what that means is it'll become a deduction, an ordinary business deduction to the partnership and S corp, and would pass through to the partners or shareholders, as a business expense, not subject to that $10,000 limitation. This tax is elective or mandatory, depending on the state. So for example, the state of New Jersey passed a new law for an entity level tax beginning with tax years 2020. It is an election. The tax is a graduated tax rate based on the income for each partner or shareholder. It doesn't get the individual out of having to file an individual New Jersey tax return. The business will pay the tax. The individual will get a credit to report on their personal tax return to show that the tax was paid by the entity. Another state that passed one was Maryland. The difference between Maryland and New Jersey, you can pay the tax on income allocated to both resident and non-resident of New Jersey, whereas Maryland says the partnership or S Corp can only pay the tax on income allocated to Maryland resident partners or shareholders. So I think there's probably about 7 or 8 states that have come out with this type of tax so far. We might see more now that the IRS has confirmed that they will allow the deduction at the as an ordinary business expense. The other thing to be aware of with because of COVID is a lot of employees are working remote, working from home now. And the concern was, well, if I have, I'm a Pennsylvania company, and now my people who live in Delaware are doing work out of Delaware, will that create income tax nexus or sales tax nexus or a requirement for me to withhold taxes to Delaware instead of Pennsylvania? It is state by state, but most states have come out and said that it will not create income tax nexus if you are requiring these employees to work remote because of COVID. And same with the income tax withholding. If you have a Pennsylvania, if an individual normally works out of your Pennsylvania office, but right now is working from home in Delaware, Pennsylvania says, well, continue to withhold Pennsylvania taxes on the wages, even though that individual is now working in Delaware. Same thing as you want to take a look at the local jurisdictions to see what they're doing. For example, Philadelphia is follows a requirement of employer standard that basically says if the employer mandates you to work from home outside of Philadelphia, you are not subject to the Philadelphia wage tax. So, if you are an employee who's working for or work commuting into Philadelphia and paying the Philadelphia wage tax, if you are now required by your employer to work from home due to COVID, you may be able to get some Philadelphia wage tax refunded to you for the days that you were working from home because the employer had a mandatory work from home requirement. So with that, thank you for your time, and we are going to turn it over to the next group. Thank you.